financial ratios, how to apply them, and analyzing financial statements. His chapter defines the commonly used accounting ratios and shows it's much easier to interpret financial information if the data can be expressed in some kind of summary format. Because of their size, numbers tend to become obscure when you examine several summaries together. Ratios are easier to analyze because they show the relationships behind the numbers concisely and simply. Ratios can be expressed in several ways, depending on the type and context of the analysis. Here are the three most common expressions of ratio relationships. 1. The two factors or numbers expressed as x to 1. The second factor is given a value of 1 and the first factor is compared to it. 2. The two factors expressed as a percentage, one to the other, f, or x%. 3. The two factors expressed as one factor to another as a component of 1, x per sales dollar, or x per day. These are clear and understandable ways to communicate financial and operational relationships. For example, the current ratio is normally expressed by the first method, x to 1. Instead of saying that the current assets are $266,000 and current liabilities are $133,000, it's more helpful to say that the current ratio is 2 to 1. Ratios let you boil down information into a usable form. Rather than merely presenting financial data, ratios interpret and draw attention to significant conditions and trends. Ratios can be used two ways. 1, to indicate a single business condition. Ratios are used alone to express a relationship between two factors at one point or period in time. 2, to indicate a trend. Two ratios from different periods or points in time are compared to show the amount of change between the first one and the second. When ratios stand alone, they serve as general indicators of conditions, strengths, and weaknesses in your business at any given time. To make them more valuable, compare ratios. Use this way to some standard outside your own company. You can get lists of average expense ratios from the Internal Revenue Service, and Dun & Bradstreet publishes the vital ratios of selected companies in all fields. The current ratio, for example, is used universally to measure a company's ability to meet current obligations from current assets. A 2 to 1 current ratio is the minimum current assets to current liabilities considered healthy for a business. A 2.5 to 1 current ratio is better, as explained later. Two ratios from different periods can be compared to show how your business has changed over time. A trend is established when a ratio changes, indicating a change in the business condition the ratio describes. You find the trend by figuring the ratio in one period and the ratio in the second period, and then comparing the two to find the amount and direction of change. When you calculate this several times with ratios in successive periods, you plot a more reliable trend than if you use only two ratios in different periods. Here's an example of how a trend shows you more about business than a single ratio. Charge sales to total sales are. To 1 isn't a particularly significant statement by itself. It's more meaningful to say that the ratio of charge sales to total sales has increased from 65% last year to 95% this year. It indicates a larger increase in that portion of sales made under credit terms, and it prompts you to ask the following questions. Is this a true increase, or are the numbers somehow distorted? Are there many customers now participating in new charge sales, or just a few? Are they good credit risks? These questions are all inspired by one ratio calculated at least twice, once last year and once this year, at the start and finish of the period under study. The answers to them provide valuable information on the various aspects of the operation affected by the change in account relationships. Ratios give specific kinds of information that you can use to analyze your operation. There are four main reasons for doing ratio analyses. 1, to check existing conditions and relationships as indicators of business health, so you can control and change them in the future. 2, to spot trends for the purpose of establishing standards and producing controlled yields within these standards. 3, to check on the effectiveness of existing controls. 4, to measure the levels of various accounts in relation to other similar accounts. You can calculate ratios based on two balance sheet accounts, on one balance sheet account and one income account, or on two income accounts. In addition, ratios can be created which compare non-financial to financial information. The rest of this chapter gives examples of how to form these ratios, what they mean, and how to use them to better analyze and manage your business. Balance sheet ratios. Ratios that involve accounts found only on the balance sheet are called balance sheet ratios or financial ratios. The current ratio compares current assets to current liabilities. Generally, a 2-to-1 current ratio is considered the satisfactory minimum. This means your current assets should be double your current liabilities. Compute the current ratio as follows. The current ratio is always expressed as X-to-1. This ratio is favored by loan officers and credit departments as a good indicator of financial health. Since current assets are those you could convert to cash within 1 year, they represent the liquid assets of the company. Expect to pay any current liabilities within the same period. The current ratio gives a good idea of how able you are to meet current obligations with current assets. The quick assets ratio. The quick assets ratio, or the asset test, as it's sometimes called, is similar to the current ratio. It's also expressed as X-to-1 and is calculated using the same accounts as the current ratio. A minimum of 1-to-1 is considered healthy for the quick assets ratio. Compute this ratio as follows. More conservative than the current ratio, the asset test measures the immediate ability to pay current debts. Since inventories aren't necessarily available and may not be converted at all within 1 year, they aren't considered as readily available. The capital to current liabilities ratio. The capital to current liabilities ratio is used to determine the owner's investment in a business versus the creditor's interests. Establish the relationship of debt to investment by comparing these two accounts. Capital equal to owner's investment versus creditor's interest, current liabilities. The capital to current liabilities ratio is expressed as X-to-1, or as a percentage. When the capital to current liabilities ratio is expressed as a percentage, it indicates how much of the non-current assets have been supplied by investment and how much by outside funding. For example, a ratio of 100% means that the owner of the business has supplied all non-current assets. A ratio of more than 100% means that the owner is supplying a portion of current assets as well. A ratio of less than 100% means that the current assets and part of the long-term assets are supplied by creditors. Review this ratio along with that of capital to funded debt or non-current assets to find the amount of fixed asset investments. The working capital to funded debt ratio. Working capital to funded debt indicates the ability of an operation to meet its obligations. It also indicates whether a business is heavily dependent on outside funding. It is expressed as working capital is the net amount of current assets available, computed as follows. Current assets, current liabilities equal to working capital. The specific current assets to total current assets ratio. The specific current assets to total current assets ratio shows you what % of total assets the company's specific assets represent, such as inventory to total assets or cash to total assets. Specific current assets. Total current assets. Compare specific current assets to total current assets ratios over a period of time to come up with trends showing how your distribution of assets is changing. Figure 23%-1 is an example of this ratio analysis for a 5-year period. While accounts receivable have increased as a portion of total assets from 26.6% to 37.3% in 5 years, inventories have declined during the same period. This type of analysis can be misleading, especially when reviewed by itself. Instead, compare the figures against those of a similar analysis of sales in the same period of time. While accounts receivable represent a larger share of total accounts classified as current assets, the actual amount in relation to total sales may have decreased. It's hard to tell whether the trends are good or bad without a full knowledge of the rest of the operation's activities between the year this was drawn up and now. Analysis of current assets. Figure 23-1 analysis of current assets. The net worth to assets ratio. The ratio of net worth to assets shows what share of assets is financed by owners and what share by creditors. A variation of this ratio is that of net worth to current assets. This shows how much of working capital is financed by ownership and what part by credit. Use these ratios to analyze the relative investments in your assets and liabilities accounts. Combined ratios. Ratios that compare accounts on the balance sheet to accounts on the income statement are called combined ratios. When you develop ratios for financial analysis, remember that the two accounts in the ratio should have a logical relationship to one another. For example, it makes no sense to compare accounts receivable to payroll. Receivables and payrolls have nothing in common. At the same time, there are accounts which, although they are related, simply don't lend themselves to comparative analysis. For example, inventories are related to sales, but you shouldn't compare them in a ratio because the two accounts are presented on a different accounting basis. Inventories are kept at cost, while sales are designed for a margin of profit. When you work with combined ratios, make sure the balance sheet accounts and the profit and loss accounts used are accounted for on a similar basis and bear a logical relationship to one another. Otherwise, the ratio you calculate will be misleading. The sales to accounts receivable ratio. Use the sales to accounts receivable ratio to analyze a trend in your charged sales policy. This ratio is normally expressed as X to 1, accounts receivable. Don't conclude anything from this ratio unless the month-end activity for charge sales is consistent each month. Increased charges toward the end of a month will throw comparative ratios out of line if those month-end events belong properly to the following 30-day cycle. Examine this ratio over a year to determine a fair portion of charge sales to accounts receivable and whether more stringent controls over charge sales are needed. Compare average sales to average receivables for the period under study. This allows large seasonal distortions to be absorbed and may indicate a fairer trend, especially if major variations in sales and accounts receivable balances occur from month to month. The real turnover or physical turnover ratio. The real turnover or physical turnover ratio is one of the most helpful ratios a builder can calculate. You learned earlier that the inventory turnover ratio isn't reliable because it compares net sales on a markup basis to inventory on a cost basis. The two aren't comparable, but the real turnover ratio takes this into account. This is normally expressed as a certain number of times. Real turnover of inventory occurred 7 times last year. The value of this ratio is that it indicates the number of times the inventory is replaced. The preferable inventory number to use is the average inventory, but an ending inventory can give you a good indication of turnover. A good application of turnover information is to divide the number of working days by the turnover to determine the days of inventory available to the builder. Total working days in 1 year equal to number of days of inventory available turnover. Be aware, of course, that the number of days of inventory availability changes with the inventory level. Take this into account along with any seasonal changes in business volume. These ratios can help you control the amount of dead stock on hand and the problem of under or overstocking. Other useful ratios. The maintenance to fixed assets ratio provides you with a guideline to control maintenance expenses in relation to your investment in fixed assets. Remember that fixed assets are usually a builder's largest investment. As more equipment is acquired and existing equipment ages, you can expect higher maintenance costs. Large increases in this account from 1 year to the next don't necessarily mean that the expense is uncontrolled. There should be a relationship between maintenance costs and new equipment purchases, old equipment disposals, old equipment aging. Each piece of equipment reaches a point in its useful life when maintenance cost exceeds the investment value for productive use of that equipment. If you develop good systems for analyzing profitability from equipment use, you can recognize when this point occurs and dispose of the equipment. A narrowing margin between maintenance expenses and fixed assets as maintenance rises is one of the signs that this point is approaching. When the overall ratio begins to change, perform the test on each piece of equipment, even though you may already know which equipment is causing problems. You can calculate the ratio by equipment piece if each piece has a complete cost file, as shown in Chapter 13. The ratio of equipment depreciation expense to equipment is a good way to check your depreciation policy. This ratio shows a rapidly decreasing percentage if you have few pieces of equipment and use accelerated depreciation methods. You should be able to tell from experience what the average real useful life of equipment is and when to plan for replacements. Include in your replacement estimates a careful study of maintenance expenses by piece of equipment. Use the net income to net worth ratio to check the overall efficiency of your operation. Unlike a comparison between income and sales, this ratio provides you with a true investment yield because it shows how the net assets of the operation have been applied to produce real profits. Income account ratios are used to analyze the relationships between gross profit and sales, expenses and sales, and net profit and sales. The gross profit to sales ratio is expressed as a percentage. The ratio indicates the degree of control over direct costs. Builders often find that this ratio begins to move in an unhealthy direction, with significant increases in volume. This results from seasonal changes and from sudden market increases or decreases. Business owners tend to relax their controls when money isn't tight, and this ratio is a good control guide. Changes in market types and in the cost of materials and labor also affect the gross profit ratio. The ratio acts as a warning signal. If costs are increasing, adjust your pricing policies to reflect those increases. Otherwise, your markup won't produce the yields that it did before the increase, when it was adequate to cover expenses and allow profits. Calculate the operating expenses to sales ratio when sales volume changes significantly from month to month and year to year. Expense controls need adequate monitoring in an environment of change. Calculate the ratio regularly to spot expense changes, then identify the causes. Changes can indicate either an increase in management control efficiency or a reaction to a change in volume. Study the ratios for a period of time to establish a trend. Then make your expense expectation for a sales volume goal. The net income to sales ratio shows the margin of profit. This is usually expressed as a percentage. This ratio is most useful when applied to financial statements broken down by line of business. Statements prepared this way minimize, but do not eliminate the difficulties of assigning expenses to business lines. Assigning expenses is always an estimate at best. If you're satisfied that your assignments are fair and reliable, analyze the different yields on the product and service mix. You may find, for instance, that 20% of total production time is spent on high-yield jobs that yield 50% of profits, and that the remaining 80% of production time is spent on lower yield but necessary jobs. Presenting ratios. Presenting ratios to others is as important as calculating the ratio itself. To have meaning, the ratio should be expressed so that its significance is best understood. There are 4 ways to present ratios. 1, as x to 1. 2, as a percentage. 3, as x per y. 4, as a fraction. Figure 23-2 shows samples of 3 ratios. The current ratio is expressed as 2 to 1, the best medium for exhibiting this particular relationship. The days of inventory available are expressed in the x per y format, the number of days. The gross margin is expressed as a percentage. This commonly used ratio is almost always presented in this format, demonstrating the percentage of margin before expenses. Many books have been written on the subject of ratios and financial analysis. Generally, these are intended for use by bankers, loan officers, accountants, and financial analysts. Remember that management conclusions drawn from detailed analysis aren't often expressed in ratios, but ratios can be used to support a management conclusion. Comparative ratio analysis. You can't calculate any ratio only once and expect it to remain valid for long. Businesses change constantly. You've got to compute the same ratio at regular intervals to show the trend of the activity reflected by the ratio. The more frequently you compute the ratio, and compare it with earlier ratios, the easier it is for you to draw conclusions based on the trend. Analyze activities in your business using the most complete, comprehensive data available. Include all data that affects the activity in your study before you draw conclusions. For example, you can analyze sales trends in two main ways. You can trace sales totals over a period, but that doesn't include data that significantly changes those figures. Analyze sales along with net profits for a full year to discover the quality of your volume changes, not simply the dollar amount. This gives you the most profitable volume range for your business, since the data includes seasonal volume fluctuations and seasonal net profits. Here are some useful reports comparing related activities. Many activities also lend themselves to comparative ratio analysis. Average accounts receivable compared to average total sales. Inventory and inventory turnover ratios compared year to year and season to season. Progressive repair and maintenance expenses compared to total fixed assets. Sales volume compared to net profits. Comparing your own ratios to those of another operation has some value. But remember that no single company is average in any industry-wide ratio survey. Every business is unique, having its own set of underlying conditions affecting its ratios. Concentrate on your own operation. You know the conditions that make your ratios what they are. Establish acceptable ratio relationships for your own business circumstances. Set a personalized standard for the financial health of your company. Establish high and low ratio ranges, then check the effectiveness of your controls with monthly ratio analyses.